Hi everyone, Mathis Connor here with Connor Management Group, and this week we're going to read to you another one of our recent blog posts that we think you'll find pretty helpful and informative. The title of this week's post is Understanding Warren Buffett's Most Important Quote. Okay, here we go. Warren Buffett is the man. He is the E.F. Hutton of modern times. When he speaks, people definitely listen. He seems to have so many witty quotes floating out there on the internet, you almost wonder if he really has said them all. Here's some sharp and short ones that come to mind. Rule number 1, never lose money. Rule number 2, don't forget rule number 1. Wall Street is the only place that people ride to in a Rolls Royce to get advice from those who take the subway. And the third one is price is what you pay, value is what you get. Well, many of us have heard these before, and we all probably had a little smile after reading them. After all, the advice readily makes sense. These quotes are simple, straightforward, and wise. Well, while I like these Buffett quotes as well as a host of others, the one I found with the most wisdom is none of the above. In my opinion, here is Warren Buffett's most important and revealing quote. We, Berkshire Hathaway, never buy a company when the managers talk about EBITDA. There are more frauds talking about EBITDA. The term has never appeared in the annual reports of companies like Walmart, General Electric, or Microsoft. The fraudsters are trying to con you, or they're trying to con themselves. Interest and taxes are real expenses. Depreciation is the worst kind of expense. You buy an asset first, then pay a deduction, and you don't get the tax benefit until you start making money. We have found that many of these crooks look like crooks. They're usually people that tell you the things that are too good to be true. They have a smell about them. End quote. Well, that quote is not short, and it's not necessarily simple. But from the tone, you get the feel that Mr. Buffett is rarely this direct and bold about issuing a warning about the types of managers and our companies to avoid. EBITDA, pronounced EBITDA, is a modification of the profit formula. Profit equals revenues minus expenses. Again, what's important to remember is that this is a modification of the profit formula in an attempt to simplify things. Unfortunately, it's a very deceptive modification that old-school businesses and not-so-wise managers widely used a while ago until many realized that this oversimplification has serious analytical deficiencies. Well, with just a little of your patience, I'm going to explain the meaning behind Mr. Buffett's last quote and at the same time raise your investing game substantially. I've been in many a meeting when the senior person is ranting on about EBITDA, much to my own disbelief. In a minute, you'll see why this is such a major reason for concern. The short diversion will be well worth your time. It's about accounting, and don't run away. The two key concepts here are actually quite simple. The two key points regarding business accounting are, number 1, the purpose of accounting is to measure a company's performance over several years, not each year individually. Accounting does this by realizing that at times a company spends money on equipment that will last for several years. Therefore, since the benefit of purchasing equipment lasts several years, accounting rules have you recognize the cost of that equipment gradually over 7 years. You can think of this as a partial charge against your profit as opposed to a one-time big expense. So for those of you with some business background, these partial charges are formally referred to as depreciation and or amortization. And this relates directly to Buffett's quote above. Number 2, if you ask 99 out of 100 people, what is the formula for calculating profit if you ran a business? They will say, duh, revenues minus expenses, with a little, you think I'm stupid or something. Well, this is where common sense and the field of accounting depart a little bit. So those are the 2 key points. Just wanted to set you up with the explanation. So let's say you're running a successful lemonade stand in front of your home. At the end of the month, you know how much money you collected. That is your revenue. Similarly, at the end of the month, you know how much money you spent. However, all that money you spent is likely not what accounting considers to be expenses. What? You say? I say yes, exactly. What? Since your lemonade business was doing so well, at some point you realized that you needed to buy some pots for boiling those lemons, as well as a new stove. These pots and this new stove are going to last you several years. Since the purpose of accounting is to measure the performance of your business over several years, accounting will not count the cost of those new pots and new stove as a full expense in the year you bought them. Accounting rules will say just 1/5 or 1/7 or 1/10 of the cost of those pots and stove every year as an expense by calculating your official accounting profit. How much each year depends on the type of equipment purchase. So the upside is this. Everything you need to spend money on to run a business is not considered an expense under accounting terms. These other things you spend money on are formally called capital expenditures. So think about this for a moment. Suppose you're about to invest in a business and someone only talks about revenues and accounting expenses, also known as EBITDA. He or she is ignoring all the additional money, like capital expenditures, you need to run the business, and is ignoring the partial charges for capital expenditures each year. Therefore, they are painting an overly rosy and misleading picture of how much money the company is really making, as well as its financial strength. This is exactly what the measure EBITDA does. It ignores a bunch of important stuff. Specifically, EBITDA stands for earnings, so that's profits, before interest, taxes, depreciation, and amortization. EBITDA ignores all of the cash necessary for capital expenditures to successfully run a company. EBITDA ignores all of those related depreciation and amortization charges. Similarly, EBITDA ignores interest and tax payments, additional very real cash drains. So once again, quoting Mr. Buffett, we'll never buy a company when the managers talk about EBITDA. There are more frauds talking about EBITDA. That term has never appeared in the annual reports of companies like Walmart, General Electric, or Microsoft. The fraudsters are trying to con you, or they're trying to con themselves. Interest and taxes are real expenses. Depreciation is the worst kind of expense. You buy an asset first and then pay a deduction, and you don't get the tax benefit until you start making money. We have found that many of the crooks look like crooks. They're usually people that tell you things that are too good to be true. They have a smell about them. So in summary, in business, everything you need to spend money on is not classified as an expense. The things you spend money on in business are expenses and capital expenditures. And for those hardcore accounting guys out there, please, I'm keeping it simple for what most people experience greater than 90% of the time. If someone is talking about EBITDA, they're ignoring capital expenditures, and they are therefore kidding themselves and misleading you about the health of their business. In lieu of EBITDA, a manager should be talking about earnings/accounting profits, and 2, cash from operations, among other items, both of which I'll save for another discussion. So the next time you hear a company or manager talking about EBITDA, and I've heard it many a time, run the opposite way. They will likely speak with confidence possibly even arrogance. Just stop and realize that they are among those second-tier, second-rate managers that have no idea what they're talking about. These managers are real. They continue to exist. Be on the lookout, and certainly don't give them any of your hard-earned money. Mr. Buffett calls them fraudsters and crooks, and I'm certainly not going to argue with him. So that's all we have. Take care, and we'll talk soon.